He who educates the market dominates the market. And that's exactly what's happened in the small bay industrial multi-tenant space. Today on Stories Behind the Door podcast, we have the Senior Managing Director of Real Estate for BKM Capital Partners, Brett Turner. Welcome to the Stories Behind the Door podcast. I am Thaddeus Campbell, Director of Business Development and Strategic Branding at S3 Partners. We've got 30 years, over 300 ground-up developments. If you have a parcel and need some help, we can help make that dream come alive. Very excited to welcome someone who gave an incredible keynote address in New York City last fall at the initial Small Bay Summit. I'm going to hop right in with him in a second. Before I do, I got to give a shout out to my partners at Kiwi 2 Construction. They have supported this show for so long and in such a great way, allowing us to have these incredible conversations in both self-storage and small bay industrial. Wayne Woolsey and his crew, you can reach out to them at kiwiconstruction.com for any needs you have in steel, and they will be able to help you out. Now I'm going to jump right into it. Brett Turner, BKM Capital Partners, thank you so much for carving some time out. You're out on the West Coast, so it's 8:30 a.m. in the morning on your time, so I really appreciate you taking time to come and join us on the podcast.
Yeah, Thaddeus, thanks for having me, man. I'm a little bummed you've got the shirt on. I thought you were going all Bert Kreischer now and jumping in snow and things like that. This video you posted on LinkedIn was incredible.
If I knew how much response I was going to get from that video, I'd have done it years ago. It's kind of funny. Who knew me taking my shirt off and jumping in snow was going to get that kind of response? We got to have a little bit of fun in life.
I totally
agree. 12 degrees outside with snow on the ground, so got to do something to keep us entertained.
Come to Newport Beach. It's 73 degrees and sunny.
I in a heartbeat. I got a daughter in 9th grade who refuses to leave New Jersey, so I'm stuck for a couple more years, but it's going to happen. Listen, I'm going to pivot here. I always ask the same question to start the podcast. We are in such a niche business, right? Whether it's, a lot of people I talk to in self-storage, for you guys at BKM Capital Partners, really heavy in the small bay industrial space. It's not what people typically set out to get into when they're defining a career path, whether it's in high school or college. So how did Brett Turner get to this place with BKM Capital where you guys are really the leaders in this small bay industrial space?
Yeah, I know. I appreciate the question. And we started probably 13, 14 years ago, something along those lines. My whole family is in real estate. My great-grandfather owned hotels. My grandfather owned apartments. My dad was a real estate attorney. So I always knew that real estate was going to be my thing. In college, I started selling land to home builders, did some investment banking at Barclays in New York, and then back here in Southern California doing industrial acquisitions. But really the moment for me was hooking up with our CEO, Brian Malliott, back at our predecessor company and trying to build a company that's vertically integrated that could take the institutional capital with a lower cost of capital, apply it to what had historically been privately owned multi-tenant industrial parks, and make that arbitrage. That was what we set out to do. And I think we've done that pretty well.
I would say you've done it pretty well based on the keynote speech and some of the numbers you went over in New York, which we'll dig into in the rest of this podcast. But I want to ask, why small bay industrial? Why this multi-tenant asset class? What about that? Obviously, for the last 13 years, really for the last 20, 30 years, big box has really been the name du jour in industrial, those Amazon type warehouses. You went a different path and quite successfully. What did you see that made you go down this route?
Well, when you think about value add, you can't really do that in a big box distribution center. You can build it. That's value add. That's certainly, to me, that's really more opportunistic risk. With multi-tenant industrial parks, it's hands-on. It's a management business, right? You need to be turning over leases. You need to be painting the buildings, reinvesting and adding capital, things along those lines. That's hard to do in big box distribution. If you look at the small bay space, it's very difficult, but you can do it. And that's really where we wanted to excel. We didn't want to be another fund manager that is really just trying to make money on the buy. We wanted to make it through our operations.
And you guys chose specifically to go the acquisition route and concentrate on that value add side post something already being an existing facility. Why that choice rather than go the development route?
Well, you really can't buy this stuff, for more than replacement cost. The discount to replacement cost in the small bay space is absolutely staggering. I think it's probably the most effective place to put your money. So if you think about what we're buying currently, it's usually about 60 to 80% of replacement cost. There's certainly areas that you can start to see that development, but it's relatively small compared to some of the big box space. A lot of what we're selling actually is to redevelopers that are actually tearing it down, taking that supply off the market, and more so than we're seeing new development come in.
It's so fascinating you say that. I've spent a lot of my career in commercial real estate and self-storage, and we're seeing the exact opposite. We're seeing people get bailed out of developments that probably shouldn't have been built because someone's willing to pay for it for more than replacement cost just because they don't want to go through that process. And guys are getting saved on projects that might otherwise not look good. What is it about small bay that you think that is allowed to have that
Yeah.
arbitrage? I mean, 60% of replacement cost is a deal. It's hard not to have that turn into a deal.
Yeah, well, if you think about the development cycle, right? If you're building a small bay business park, you got 200 tenants. You're going to spend 3 years entitling it, building it, things along those lines. Maybe that's 2 years, but then you got to go find 200 bodies to occupy it. And so the market might be on fire, but that's a lot of people. And so your development cycle is longer. The markets are great, but they're cyclical. And you can hit it really, really well, but that timing and that risk is typically extended. Also, to be honest, the cities don't really like it. If you think about how a city is constructed, you usually have an urban core in the middle, and then you have housing on the outside, and then you have industrial even wider than that, right? And so between the residential and the major industrial places, you have this sort of small bay light industrial type of product. And then as that city grows, it sort of consumes those small bay parks. And so those are because of the low coverage, it's usually like 30, 35% coverage on that site. It's sort of the prime candidate to get torn down, go to multifamily, go to office, go to some kind of higher use. I don't know if office is a higher use these days, but there's that supply gets taken offline time and time again. Now, that doesn't mean the need isn't there. I mean, I think especially with sort of last mile logistics and e-commerce and everything that I'm sure your guests have talked extensively about, that demand keeps increasing, but the supply doesn't increase along with that demand.
I think it's fascinating what you said. One of the things that's blown me away is obviously we're going down this road of building ground up is the lack of supply for a segment of our economy that's exploded over the last 30
Mhm.
years, right? Those small businesses, people with no W-2 employees, it's grown by 3x since they started tracking it in the 90s. And yet your point that I've never heard before, so I appreciate you bringing it up. This is kind of the best thing to squeeze out, whether you're looking for a big industrial, somebody that's going to employ 2,000, 3,000 people, or you're looking for those more consumer friendly commercial spaces where it's not quite as a quote unquote blight on the community, have really put pressure on this space. And how has that helped you guys as you're acquiring these assets be able to fill them and see rates continue to rise?
Yeah, I mean, it's just that, right? I mean, the demand is more so than the supply. If you think about what we saw this last cycle, tremendous supply came online, around 21, 22, a little bit into 23. It's slowed down a lot, but that's all in the big box logistics space. And there was certainly a need for that. But developers do what developers do time and time again, and they kind of keep dancing when the music stops. Um, that just didn't happen in the small base space. Again, along with that growth in industrial, you also saw a big boom in multifamily. And so any of that developable land, especially on those infill locations, really went the multifamily route. You didn't see that as much in the small base space. So I think only 2 to 3% of the total new supply that occurred this last cycle was really in that small base space. Now, what that did, especially as technology came into logistics, is it shrunk the footprint of a lot of those big box users. So now not only is there more supply, but there's also less of a need for that bigger space. And I'll give you a great example. So got this tenant down in San Diego. They make artificial hips. There's a big facility, hospital, Scripps Hospital, and what this company used to do is it was 50,000 feet. And I'm going to exaggerate here, but essentially the first third was their sales staff, right? And now all that is done online, so you don't really need that first third of the unit. And then the second third of the unit was the manufacturing center. And they would make small, medium, and large, hips. Again, I'm exaggerating, but now that's all done with 3D printing. And so
Right.
you don't need these big machines. You need these small little 3D printers that can kind of customize it for you. And then the last third was this, the warehouse storage area waiting for the FedEx truck to come once a week. Well, now you're doing same day delivery. So instead of big 53-foot trailers, you've got these Sprinter vans that are coming every single day. So what that did is it took a 50,000 foot user, shrunk it down to 5,000 feet, and that is occupying our space in San Diego. And so the technology that's come into the space has really driven demand for the small bay space, but also reducing the overall footprint of that need for the large bay.
It's fascinating. And one of the reasons I was so excited to have the conversation with you, because you're on the front line of this and seeing things that, most of us not even heard about, that minimization. I've never heard technology
Yeah.
having had that effect, which is fascinating. I want to kind of pick your brain a little bit, more than a decade in the space. How has it changed for you from when you and your partner first decided to go this route of acquiring small bay industrial versus what your tasks are today?
Well, the market's certainly been educated. I said this at the keynote, but I remember being in a major financial firm's office when we're raising Fund One, and God, it was so hard, man. I mean, we had I think 90 meetings. We really got two institutional investors, and the rest were high net worth. But I remember being in this firm's office, and I'm looking across at this 30-year-old kid, and he's scratching his head. He's like, "Okay, so it's small business. It's like less than 500 employees, right?" I'm like, no, no, no. It's like 5 employees. And that was the end of that meeting. That
Yeah.
ended really quick, but there was just the institutions couldn't comprehend what this small bay product type was. Now, we've put out a lot of white papers, we've helped educate the market, and we've had a lot of tailwinds at our back. So it's certainly been noticed. And what that's done is it's really started to educate these larger players that are looking to deploy capital in industrial, but see that oversupply in other sectors and want to funnel it into the space. Now, there's a big problem. A big problem is that, going back to what we said earlier, because of that development cycle, nobody really builds this over 200,000 square feet. So
Yeah.
200 bucks a foot, 200,000 square feet, that's a $40 million asset. That really doesn't move the needle for a large institution, right? I mean, JP Morgan isn't going to notice a $40 million acquisition. And so what we saw primarily in 22, 23 was as we were going to sell these assets, we'd get 10 to 12 offers typically, but now you had another 10 to 8 offers kind of on the bottom of that sheet from these larger institutions that are trying to get educated in the market, look for a way to take a position, but because it's such a management intensive asset class, you need a manager that's vertically integrated that understands how to operate these things. And that's hard to do. And then you also need a large portfolio to seed any kind of investment to make sure that it moves the needle. And so that's what we started seeing in really 24, and it's continued into 25. And now we're starting to see it in 26 as well, where these large institutions that typically would have nothing to do with this sort of small bay, little tenant, things along those lines, they're now educated. They've are willing to take positions. They're willing to get pretty aggressive on the buy.
I love this, and it opens up a question I want to ask anyway. It's this life cycle of an asset, right? And you
Mhm.
guys obviously you did the hard work, right? You suffered that pain of. I have a close friend who always likes to say, "Who educates the market owns the market." You guys really got in early and had to do that hard work of going out in front of 90, 100 people just to raise money. Now we're seeing that shift. And where I want to go with this question is, you talked in the keynote about how much of a struggle it was to raise the first fund. You raised almost 3 times as much in the second fund, and
Mhm.
it was way less of a challenge to do that. What's that gonna do in the market, specifically in this niche of small bay as far as cap rate compression? I ask this, I'm gonna give a little
Yeah.
color to this. We're looking in storage, right? Public Storage just did their third quarter earnings call a couple months ago. They're buying at a 5 and a quarter cap in a 6.5% lending market, right? We haven't
Yeah.
really seen that compression in the small bay industrial side. At least I haven't. Maybe you have. Maybe you have a little different take on this. But I'm interested to see what your thoughts are as far as what might happen in this sector relative to cap rates.
Yeah. So right now on the West Coast markets, we're seeing cap rates range from, you call it a 525 to a 575. In some
Yeah.
of my Southeast markets, I'm not in the Northeast, but in my Southeast markets, I'm seeing that expand to probably 575 to maybe 6.5.
Yeah.
Um, you're still seeing negative arb in in the financing markets, but that's coming down very, very quickly. Um, the spreads, probably in the last 6 months, I'd say has fallen, you know, 25 to 50 bips.
Wow.
Last deal we did, I think we did at 180 over. We're about to do 175. And so there's a compression that's occurring that's making that look more and more attractive. I think anybody who's getting in the market right now should be really focused on cash flow. And as we see rates continue to fall, I think that's going to create a higher cash yield that's going to support a lot of these distributions that have been promised and really start to save people from a return perspective.
Thank you very much for that explanation, and it says a lot about what's going on right now. I'm gonna broaden this question out because you talked about that compression that's happening. There's been a little bit of craziness going on in the financial markets with some of the broader. I'm not gonna get into a
Yeah.
political conversation, but some of the broader things that are happening both domestically in our country and then with foreign policy. How do you see that playing out with interest rates? Do you see it having a negative effect? Interest rates maybe starting to inch up, or are you still expecting things to keep coming down a little bit?
I expect it to keep coming down. I think it's going to be slower. I don't think we're going to get to 0% interest rates anytime soon. We're going to see a leveling off here. I'd say probably 3 to 3.5% here pretty quickly. Um, a
And
lot of
how does
reasons for
that
that.
change things on your side of it? Yeah, I apologize.
From our
Keep talking.
side,
Sorry about that.
this is certainly a space where, again, you can get that cash flow, but you can also raise rents. You can do it fairly quickly because you don't have that 10-year lease term, right? Our average lease term is 3.5 years, something along those lines. I should say that we own about 100 assets with 2,100 customers. Average customer size is 7,500 square feet, and that's typically a 3 to 4 year lease term, which also means that I can mark that lease to market fairly quickly. And so I'm willing to come in, take that negative arb if I can see a path to stabilizing out somewhere in that kind of 7.5 type of return on cost, which is well above your financing metrics.
I'm interested to go down this road too. You keep making my next questions really easy because I wanted to talk about that. The upward trend in rent rates in this space has been fascinating. Quite frankly, one of the reasons I've really started to dig into it. What are you guys seeing on your side of it as far as what's happened on rental rates really since COVID?
Yeah, they're really, really pushing, right? And a lot of that is because, going back to the original question, you don't see the vacancy in this sector. And so if you look at our leasing spreads, on average, that was probably 15%. Yeah, that's pretty decent. If you think about, we're getting 4% bumps plus 15% leasing spread. This is the last month's payment to the new month's payment. On a 3 year term, that's like 27% growth, in 3 years.
Yeah.
It's pretty decent. Now that's expanded quite rapidly. I mean, I think at the peak we were probably around 35, 36%, something along those lines. That's come back, a bit, but it's still really, really healthy. I mean, I always tell people this. It's great to go to the gym. It's not great to take steroids. The market can't go at 180 miles per hour forever. Now we can still go above the speed limit, but we need to be safe here. It's not good for our tenant base to see that kind of just absolutely astonishing rent growth for very long. And it's great for us, from an ownership perspective, but we need to think about the health of our tenants as well.
I'm smiling as I got into self-storage in August of 21 and they were in the middle of an 18-month 61% boom for the REITs, which was all tied to
Incredible.
growth of rental rates. And to your point, the following 3 years were negative to flat. And what else is going to happen when you have
Yeah.
61% growth in rates in a 18-month period? So, I, on this note, do you see this kind of high, 20, 25, 30% rent growth continuing through the end of the decade? Do you see it kind of leveling off and coming back a little bit? If you put on your prognostication glasses, what are you seeing over the next few years?
I think we're going to slow down a bit, and I think that's a healthy thing. When the tide goes out, you see who's swimming naked, right? And so a lot of folks jump into the space with the idea that we're going to buy the asset, we're not going to do anything to it, we're going to mark these rents to market, and everything's going to be fantastic. Well, you can't really do that in this product type. You need to have hands-on management. You need to invest in the capital. You need to make it look nice. You need to do something that benefits the community abroad. And you're going to start to see that stellar growth come back a bit. And I think a lot of those folks that thought they could kind of look at this as a passive investment start to get out of the market, which I think is going to be healthy. We're not going to see negative rent growth. We're not going to see even rent growth at inflation rates. We're going to continue to see healthy rent growth, but it's going to be healthy. It's not going to be 1,000 miles an hour.
Something that a business owner can't sustain over a 5 to 10 year period. I appreciate that greatly. And your point is so well taken too about, and you talked about earlier with big box industrial, right? Developers do what developers do and they overbuild. It's hard to see that really happening in this space, given the restrictions, just the pure land use restrictions that it presents, right?
Oh, absolutely. Yeah, I think you're not going to see any new supply anytime soon. Now, I've seen folks like yourself try to figure it out because there's certainly a need, but trying to make those numbers pencil, man, that's a tough pull.
It's a challenge. Question I wanted to go to you. We talked earlier off camera. Listen, you don't do billions of dollars worth of transactions in any real estate asset without pressure. But the pressure that Brett Turner's under now is a little different than the pressure at the beginning. Talk to me a little bit about that. Like your day-to-day now, you're talking about, almost $400 billion you guys raised. What's it like trying to deploy that into the market?
Yeah, we're not quite 400 billion. We're about 3.4 billion of AUM.
Excuse me, I meant 400 million that you just raised. I put a B instead of an M. I apologize. You've done billions of dollars worth of transactions, not billions of dollars worth of raise. Apologies.
So that's okay. So if you think about our business, we are a fund management business primarily. We're on our third fund. We're finalizing that raise. That looks like it's going to be about a $350 million fund. We have 10 or 12 joint venture partners that do more discretionary one-off deals. And then we have a large investor that's given us $1.5 billion to go acquire these assets. And what that's done is that's taken us from being primarily West Coast markets to moving throughout the Southeast. Now, the Southeast is incredibly attractive right now. You see, it's the only area of the United States with positive domestic migration, a tremendous amount of manufacturing investment. There's a lot of reasons to like those markets. So we've taken large positions in Houston, Dallas, Atlanta, Florida. So we really, really do like that movement. But we still like our West Coast markets too. We like Phoenix, tremendous amount of manufacturing investment in Phoenix. I like Northern California, especially around AI and the advanced robotics going into the East Bay. And so there's certain markets where we can really try to generate this. But going back to the question at hand, what's that like, right? And so if you look at what we did last year, we did about 1.4 billion of transaction volume. The year before, we did about 1.6 billion. A lot of that was recapitalizing our fund two. But it has given us, a larger purview of the overall investment market into small bay because we are now coast to coast within our markets, and being selective about where we go and being able to follow those trends and being thematic about our investing has certainly helped us find the best opportunities possible.
Really appreciate you. First of all, I'm going to apologize because my phone rang. I usually put my DND on before I go on the podcast. So I owe you an apology for interrupting your answer before. I'm going to pivot a little bit. I want to know what Brett Turner does to listen. You're talking about billions of dollars that you're dealing with. What do you do when you're not working in real estate to kind of decompress and deal with that pressure?
So the wife and I are very much into fitness. We're both bodybuilders. She's a competitor, I'm a competitor. And so typically when we're not doing real estate, I'm dieting and working out.
I'm 52 now. I used to be a professional fighter, so unfortunately, I've been on that train many, many times, really paying attention to every calorie. I probably should get back to that a little bit now that you say that. That's awesome. Obviously, Newport Beach, California, is sort of a way of life down there.
Yeah, it really is. I mean, we're at the beach, a lot of the time, we live a stone's throw away. It's a pretty nice place to live. And then we've got a couple of kids too, right? I've got a 7 and 8 year old. They keep us pretty well occupied.
Absolutely love it. As I said, really, really appreciative of you coming on. I want to do the prognostication brain a little bit. You talked at the Small Bay Summit a little bit about who's coming into this space right now, and it really hasn't been core funds yet, is what you said back, I think, in
Mhm.
October, November when we were in New York City. Do you see those more core funds getting into this space over the next 3, 4, 5 years?
It's starting to. I mean, primarily it's been value add and opportunistic capital. We're starting to see that move into more core plus, especially in the mid base space. Uh, do the core funds ever come into the space in a large way? I don't know. That's really what we need to find out. I don't think it's going to happen domestically, but we are starting to talk to a number of different capital providers offshore that would have the sort of long-term 10-year view. We're talking to folks out of the Middle East. We're talking to folks in South America, a little bit in Europe, also Asia. And so I think that's really where it starts, and then it slowly migrates into the domestic capital. And so we'll see. I mean, I think you're going to be maybe 4 to 5 years out till you see a push in a major, major way with that true core open-ended fund, you know, anytime soon.
Last question I'm going to ask you, ideal asset for Brett Turner, what you're looking for, and if somebody out there is wanting to put something like that in front of you. So start out, what's the buy box? What's the perfect gem that you could add to the portfolio? And then how do they get a hold of Brett Turner if they have
Sure.
something that fits that mold?
It's really easy. It's over 20 million, over 20 tenants. Yeah, industrial assets. Our average acquisition size was, I think, 70 million last year. And so that's probably what fits the box the easiest. We're in all the Western major markets, and then we're throughout the Southeast. I think in probably 27, 28, we'll start moving up the Eastern Seaboard, but not quite yet.
Brett Turner, again, thank you so much. I appreciate the time. Appreciate your patience with me. You can see his email down at the bottom, bturner@bkmcp.com. Just, you got on a call with me shortly after the Small Bay Summit. Just want to say on a personal note, really appreciate you taking the time to share your experience and your knowledge with me there. And then obviously coming and sharing it to the broader audience on the podcast. Really appreciate that. Thanks so much.
Yeah, absolutely. This was fun. I appreciate it.
I'm glad it was fun. I didn't have that much fun when my phone rang in the middle of it, but I appreciate you being a trooper through that and keeping the smile on your face. Of course, Newport Beach in the 70s today, a little different than New Jersey in the teens, so a little reason to keep the smile on. He's Brett Turner, BKM Capital Partners, and in charge, one of the founders in charge of their real estate acquisitions. I'm Thaddeus Campbell, Director of Business Development, Strategic Branding at S3 Partners. Obviously, 30 years, 30 plus, 300 plus ground up developments we've done in self-storage in Small Bay. Reach out if you have any needs. We'll help make that happen. And a last shout out to my friends at Kiwi 2 Construction, and congrats. I'm going to keep saying this to Wayne Woolsey and his team. They just had a great exit. They're still controlling the company, but they were able to sell to Janus International, which helps them with some buying power. I'm really excited for that team. They've been the leaders in steel and self-storage in Small Bay for many, many years. So, and thank you for the support of the show. Brett Turner, really appreciate it. That's all for this week's episode of Stories Behind the Door. We'll see you next week.
Bye, guys.